Good morning. Welcome to another What's Up with the Market. We're going to do a market status as we always do. And before we get into the charts, I just want to remind you that I don't use any of the analysis I cover here today in SPA3 Investor or SPA3 Trade. It's not part of those mechanical methodologies, and nor do I use it to make any buy-sell decisions or money management decisions in the ASX and USA public portfolios. And also don't use any of this analysis to make any decisions in my own personal portfolios. Fully mechanical have been for decades, as I've just said. And I use our systems, and particularly SPA3 Investor, where most of my money is invested. And you see some of that in the public portfolios in both the US and in Australia. I have to tell you that everything that we cover here today is general investment advice. There's no personal investment advice. And with that, we will now get straight to the charts. And here we have the Dow Jones, where we always start. And just a reminder of what we've been following here is the Fibonacci retracements of the run-up that occurred. So this run-up that occurred from down over here, which is around about November, November last year, that run-up, how deep is the retracement? How deep is the pullback? And that's an indication how strong this bull market is that we're in. So we're in a primary bull market in a secular bull market. And when you hear that combination, you really want to be in the market. You want to have exposure to stocks. But unfortunately, what we have, and this is what we cover in the training that Dave and I did last November, which now a lot of our members are going through. And I really would like all of you to go through it. Just looking at some of the questions we've had on the forum recently, and it really does stand out that there are people that have just not done the training. And rather than me writing up all the training that is actually in the training intensive, I'd prefer that you do it and watch the video and do the training, because otherwise I'd have to write up some 12 hours of words on the forum. So why do I say that? Because this little pullback over here causes a little bit of emotional pain. People get a bit worried about it, but that's just the market doing its thing. And you know what it does? It also puts into perspective how strong this bull market is, or it helps us see it from a shorter to medium term perspective in the bigger picture perspective that we have of this long-term secular bull market, which we've been in now for almost spot on 11 years. So how does it put into perspective? Well, this depth of retracement being between the 23.6 and 38.2. Now, 38.2 is a normal retracement for an up or a down market, a bull market or a bear market. And what we've had here is slightly over 23.6. And now we've had a higher low and a higher high. And this high has not completed yet. So we don't know how high it's going to go. But we can quite now, from a technical analysis perspective, viewpoint, say that this low has completed. Why? Because we've had a higher low and a higher high. So that bottom is in this time frame we're looking at. So that is important. Now we've got to see what happens from here. When is if there's a new all-time high, or whether we form another high and then come down, make a higher low, and then make a higher high before we go. And that gives us an indication of the strength of conviction of buyers. And that's why we follow this stuff, because we're listening to the market, we're reading the market. But as I said beforehand, from a mechanical perspective, I don't follow that in my buy and sell decisions. We've overlaid that with the mechanical timing system that takes all of that into consideration. So we don't have to sit and do hours of prediction and analysis, et cetera, et cetera. It's all done up front. Now, the other thing to point out here on this chart, and it's really as I always do, I lay the theme on the first chart because it's much the same, and we just look for other little nuances, breadth of market indicators and sentiment indicators as we go through this to see some early signs. And there are some early signs that we are going to see today that are just, well, I'll explain to them when I get there. But what I want to tell you here is that we do the timing mechanism we have here. There's the last green arrow on the Dow Jones index. It's indicated a buy on the index, and you can do that, follow that through with an ETF. In this, we did not get an exit signal here. So this stop, if you like, this trading stop was wide enough to allow this trend to continue. And as it has, so there's the trailing stop line, the gray line over there. So we're in an open trade on the Dow Jones, if you like. But what I also do here to get some relativity on the price movement in the Dow, one of the main indices, is I measure that relatively against the S&P 500, the dollar. And when the Dow Jones is underperforming the S&P 500, then that means that there's a risk on environment. Why? Because you've got a wider range of stocks that are doing better than the Dow Jones. And you can see over here that we've got, I'll just zoom in a bit down the bottom right. That doesn't really help. I'll probably just do this. And you can see that we've got higher highs and, lower highs and higher lows. And that is telling us that we've got a little bit, and you can do analysis on an indicator of an indicator, that there's a change happening over here. And this is a symmetrical triangle forming on the relative strength line between the Dow Jones, the relative strength of the Dow Jones compared to the S&P 500. So what we're looking for there, how does that help us? We're looking for a breakout either way as an early sign. So that's a little early nuance that we can use in our analysis to get indication of whether risk on, risk off is going to pull through or not. So we'll keep an eye on that in future analyses. This now is the S&P 500, and there's the entry signal on the S&P 500. Trading stop held, wide enough stop here to let this trend continue. This is a clearer, a higher low and a higher high. This high is not completed yet, meaning it can continue going up. So that is, and we'll see how high it goes. Now, if it makes a new all-time high, that's stronger than if we form a lower peak, then have a retracement, have a higher low, and then go on. So little indications we get there. But this is, that this bull market now, the bottom is in, and the retracement has only been 23.6% on the S&P 500, which is an indication of strength. Now, if we didn't have that pullback, which is always going to happen, we have to have pullbacks, we have to have retracements. And when we have these pullbacks, people feel uncomfortable, discomfort, etc., etc. And the degree to which you feel discomfort when we have pullbacks is the degree to which you really need to improve your mental skills. And this is just a very shallow pullback. And it's one we needed to have, and it's given now an indication of the strength of this trend that we're in. So if you're feeling any discomfort, whenever we have pullbacks like that, you got to go and do the training intensive until you feel no discomfort and you fully understand in your cognitive mind what the role that plays in these pullbacks. But not only your cognitive mind, you get it instilled and ingrained in your subconscious mind, and that's what all that training is about. If you want to be a peaceful investor and be cool, calm, and collected in all market conditions, do the training rather than writing on the forum. And I'm happy for you to comment on the forum about the training. Right, here is this is a cumulative new high, new low. So what we have here, this and it's to do with the scaling, and it's just normal, is that we've got an overlay here. But what we're looking for is this cumulative new high, new low to be rising, and it has. So it had a bit of a dip there in this pullback, and now starting to rise again. So that breadth of market indicators doing exactly as it should, as is the cumulative advanced decline line. I've got a moving average on here. What is that? A 55-day moving average, and it's rising still. There's the gray line, and we've got trend lines on there. So we had this pullback, and the advanced decline line has continued to rise. So what we typically look for here is divergence. And there's no divergence there, so that's doing as it should do. This is the number of S&P 500 stocks that are above their 150-day moving average, starting to rise again. We had that fall, we were looking for divergence as we had here. That was a failed divergence. Typically what we're looking for in divergence is that the market would fall after you have this. So you have falling number of stocks above their 150-day moving average, rising market, divergence. Typically that would not, and typically percentage-wise, happens less often than what you think it does, is this turned around and went up and we didn't have the market fall and there's no divergence there. So that breadth of market indicator also doing as it should do. Now we're going to start getting into some of the more nuanced things. This is the US dollar. Okay, so what are we keeping eye on here from a smoothed perspective so we don't make any knee-jerk short-term reactions? Is I've overlaid the smooth indicator, momentum indicator here, or trend following indicator on the relative strength line, which compares the US dollar to stocks. So when this blue line, the relative strength, falling, then that is risk on. That means that equities are doing stronger than the dollar, and the dollar, US dollar, is falling. And here we now have this risk off is the last. That's why I've got the red vertical line there. So we're looking, smoothing this out, and we're waiting for this now to dip so we get that kind of situation. But here is where we're starting to get some early indications. As you can see, the US dollar is starting to fall, stocks are rising, relative strength line is falling, so the blue line's falling, as is the moving average. So we're starting to get an early nuance sign over here that this is starting to move towards a risk-on environment again. I'd be confident that happens when we get to this situation here, when we get a green line of so the Ciroc falls below its moving average. That would be a risk on. So, but the early signs are there, and that is a theme that you're going to see on all of these charts I'm looking at now. Remember, these are sentiment and breadth of market indicators that we're looking at. So we're doing intermarket analysis, if you like, between indices, between dollar, and we look at commodities. So we're doing all this intermarket analysis to look for early signs of what is going on. Now, this is using the Russell growth versus Russell value sector indices. You can see here that we have a risk off, which is that line over there, which came on the early April, and we saw it was pretty good timing because you can see that what ensued after that. But now we're starting to get a turnaround. So this is a smooth indicator, so it's not going to knee-jerk react to 1, 2, 3 week movements. It needs a bit more momentum, a bit more trend behind, a bit more proof, if you like, behind the data before it starts moving. And that's just the settings that I have on there, which I've eyeballed and just used my experience to come up with. They're not all the same setting. And what we're seeing here now, and you can see this with the naked eye, is the relative strength line is starting to rise, meaning growth is starting to outperform value. And because typically in a risk-on environment, growth does better than value, and vice versa. In a raging bear market, you'd find value would do better than growth. But with the naked eye, you can see that the growth is rising at a steeper gradient than what the value is. And you can see that through the relative strength line. That means that's why that blue line is rising. And you can see the moving average on the relative strength line starting to move as well. So what we're waiting for is another green line like this to occur. And it's not going to happen in a day or 2 or 3. It'll take a week or 2 or 3 to form. So we'll certainly keep an eye on that for you can look forward to that in the next session in 2 weeks' time to see if this have also moved in line with the short-term movements of the actual indicators themselves. Right, what do we have here? We have consumer discretionary versus consumer staple. It's also got this red line. So we've got all these situations here where there was enough retracement, even though it was relatively shallow to the run-up that we had in those indices. We've got these risk-off lines over here. So what you can also see, another part of this, what's happening, the early signs are the relative strength line between discretionary and staple is starting to rise as the moving average hasn't quite turned up yet. But you can tell here that that's discretionary rising, but so staple, but discretionary is rising by more than staple, which means early signs of a risk on coming back again. You can also see that we've got a buy signal on the XLY being the spider of the consumer discretionary sector in the United States. Right, this is put call ratio. This is one that we have turned. So this is a little bit more sensitive, although it shouldn't be. Well, I've got a 30. What have I got here? 26.9 indicator, right? And the other period's a little bit longer. So what we have here is there are more calls that are being bought than puts. So that is a risk on. You can see that the timing of that occurred pretty much on the dip. This is the S&P 500 index over here. You can see how sensitive that was to it, even though this is a 252-day moving average on the put call ratio. So that's a 1-year moving average, if you like. So that's called. So this is an early sign. This is the first indicator that's gone back risk on, more calls than puts in the call put ratio. Now we're looking at the 10-year Treasury note yields. So this is the yield. The yields are starting to fall, still in the uptrend channel over here, and you can see the risk on is still there, but the relative strength line between yields and stocks is starting to fall, meaning stocks are starting to outperform yields. There's the S&P 500 over there. So this is another one where there's an early sign of the indicators themselves in the shorter term moving, but the more medium to longer term trend timing that haven't yet responded because they're pretty smooth. So, but early signs in this one as well. And they're all, you'll see it coming right through. Now, what's happening here? This is the TLT, 20-year Treasury bond as opposed to yield. And typically you should see bonds, the bond price and stock prices moving in the same direction. What I've done on this chart, and when you download this, you can go back and look at more data if you want to, is these dark blue lines and red lines. So the dark blue on the S&P 500, the red on the 20-year bond price. When they go in opposite directions, I've put trend lines on the chart. So that's when they're not doing what they should do. And when there's no trend lines, that's when they're doing what they should do, going in the same direction. And remember that yields will go in the opposite direction to the bonds. So effectively, when bonds and stocks are going in the same direction, it means yields are falling, and that's good for stocks. So this is doing what it should be doing. I had a trend line over here, a channel line over here running from December last year, and just in this pullback, this 23.6% retracement, Fibonacci retracement on the S&P 500, it broke out the top of the channel. I kept the channel in there to see if it came back into the channel or not. Certainly did, and now it's fallen at the bottom of the channel, which is another early indication of risk on. So the early signs are all lining up over here. Similar with now this is the NASDAQ composite. This is the whole composite, the whole NASDAQ index, all 2,300 odd stocks, and it's given another entry signal. So this has gone risk on. You can see the relative strength here. It's starting to rise. That's between the NASDAQ composite and the S&P 500. There is the risk off. It is quite a long risk on over there, even through the retracements. We still had risk on, where, as denoted through the sentiment relative strength ratio between the NASDAQ and the S&P 500. This is falling, but that has started rising. Early signs, smooth indicator. We wait to see in the next 2, 3, 4 weeks whether this turns or not. So you can see it's all lining up. All of these things are all lining up and saying much the same thing. So using this is the NASDAQ 100 now. And sorry, one of the things that we need to look at on the NASDAQ composite is how deep was the retracement from October, November last year to the peak there. We got to between just these blue lines here, between 23.6 and 38.2. That's pretty strong. We've got the higher low and higher high in formed. This is now still hasn't completed its peak yet to see where it is. There's the all-time high back there on the end of March on the NASDAQ composite. So that's what we're keeping an eye on as well, to see if these early signs follow through and the price action continues in the direction that it is. So coming back to the NASDAQ 100, its retracement was just shy of the 38.2. So it's slightly relative retracement, a slightly steep or deeper relative retracement than the broader NASDAQ composite, and pretty clear higher low, and this high hasn't completed yet. And we're starting to see this now is the NASDAQ 100 compared to the S&P 500. You can see that there it was underperforming the S&P 500, and now it's starting to outperform, just starting to rise. And we'll see that translate if the NASDAQ 100 continues to outperform the S&P 500, which is risk on, then we'll see this smooth indicator here, the stock start rising as well. So all the early signs are there, nothing more, well, basically doing what it should be doing. There is a slight fall over here in the number of new highs versus new lows in the NASDAQ 100, and the moving average is falling. So that breadth of market indicator is showing weakness at the moment. Nothing really to see here in the cumulative advanced decline line on the NASDAQ 100. On the breadth of market, number of stocks above their 150-day simple moving average, going in the same direction. So no, we don't have divergence there. You might say there is a little bit of divergence just between these two peaks and that two peak, where the NASDAQ 100 has risen above its previous peak, but this breadth of market indicator hasn't quite yet, but it's just so marginal, I wouldn't read anything into that. The SOX, which is the semiconductor sector, what are we looking for here? To see how the semiconductor stocks are doing relative to the NASDAQ 100. So when they are outperforming the NASDAQ 100, risk on. Not quite. And you can see that the trend indicator I have here on this relative strength line did not give a risk on, which is the red, which is the blue line dropping below the green line, or dropping below 90, the level 90. So it has stayed even through this, where underperforming was happening on the actual relative strength line, the indicator held strong. So this is risk on, and we're starting to see the moving average is rising, meaning there is some short-term outperformance of the semiconductor index over the NASDAQ 100, which is what you would want for a risk-on environment. Now, this is the All Ords. The All Ords retracement got to, on the one big red bar over here, got to intraday to 38, just above 38.2 retracement, but it's hung mostly around the 23.6% retracement area, which is that blue line over there, which is strong. Big day on the All Ordinaries yesterday, and it's starting to underperform relative strength line, starting to underperform the S&P 500, which is also risk on. So in a raging bull market, S&P 500 will relatively outperform the All Ords, which means that this blue line will drop on this particular chart. So starting to come in, you can see that during that period of time when we had the actual retracement, the All Ords was outperforming the S&P 500, i.e. going down by less, so less volatility. Right, the Australian dollar in such a market should have weakness, and it is this long-term downtrend is still intact, and that if we see some more, if we see stronger stocks, we might see weaker US dollar, and that's when the Australian dollar should get stronger. If it goes down in unison with the US dollar, there's weakness there compared to the basket of stocks against the US dollar, then that does not augur well for money coming into the Australian economy, already into stocks is what our interest is. Right, the Nikkei has fallen below its all-time high, which is that horizontal black line. It's fallen out of the trend, and it's now challenging its all-time high again. Now, why do we look at all-time highs? Well, the market knows. Participants in the market know where the all-time high is, and it's about confidence. It's about saying, yeah, buyers, we are prepared to take on these all-time highs and go to a newer high and go into, take on this adventure, if you like, to uncharted territory. Think of it as an explorer. If you're an explorer of the market, or the participants in the market are explorers, is that, do you have the confidence? Do you have the processes, the fitness, all that sort of stuff to go into uncharted territory? And that's why new highs, new all-time highs are really important, as getting to 40-year levels that indicate where the market's been before. Because when you get to above where the market's never been before, it needs a whole level of confidence and belief in the market and the economy and all the different variables and the millions of variables that there are that make up the market. So that's why we look at these things, and it's important. So it's important for the Nikkei now to rise above that, have a breakout, make a new all-time high, and get back into the channel. So that's why we keep these things. That's why I keep these things there, to see how they are doing. And for some time, it was outperforming the S&P 500 and underperformed in this little period over here. It did get to a 38.2% retracement, but found support there, and now is rising. So again, early signs, we need to keep an eye on that. Good old DAX, strongest equity market that we look at on these charts, and it had a very shallow retracement. It just touched on a 23.6 indication of strength, big bar, and it's pretty close to a new all-time high. So now we look to see if all the confidence and all the processes and everything that all the participants collectively feel they have to push this market out above its previous all-time high and go on and continue this adventure into uncharted territory. That's what we are looking at now. Of course, if it gets there and confidence fails and people have second-guessed themselves, and then that's what this price action will tell us. Strength outperforming the S&P 500. There's its all-time high up there, well above that, and there was hardly a retracement there. This retracement shallow. Let's see what it does in the next week or two to break to a new all-time high. Now, I haven't covered the FTSE much, because the FTSE has been an absolute underperformer, woeful for so long. This black horizontal line here is its all-time high from the the secular bear market that we had between 2000 and 2013. It took ages to break above it. It only broke above it in 2017, some 4 years after all the other indices around the world did not get much higher, fell back below its all-time high in the COVID, struggled to get above it again, and this is its now all-time high above the secular bear market. And why am I bringing attention to this now? Because this price action that is occurring over here is for what's been happening in the last 24 years on the FTSE is a little bit abnormal. So we're going to bring that in and just keep an eye on it. This is strength. This is real strength that we haven't seen in the FTSE. You might have seen it for little short periods here and there in the last quarter of a century. But let's keep an eye on this to see, relative to other markets, how it plays out. Outperforming the S&P 500 relative strength line over there. So we'll keep an eye on that now going forward, as well as another bit of evidence, if you like, to what's happening. Quickly, we'll look also at the Bovespa as an indication of developed markets. This is the all-time high zone over here, resistance zone. This black zone over here hasn't quite got above it yet. Been some good trades in it, and you can translate that into the ETF, but the ETF is in US dollars, so beware exchange rate variation. So that's it on the indices. Lots of early signs and some strength, certainly from a Fibonacci support level, looking pretty good. Right, we'll quickly now go to commodities. The CRB index, some weakness at resistance here, and that's really because of oil. Look at gold. There's the breakout, all-time high, previous all-time high there. I've put this channel in. That's a pretty good channel, good touch points there. Fallen out of the channel, underperforming equities. Let's see where this pullback goes, because there's some factors, call them fundamental if you like, that are pushing gold. They're not your traditional fundamental factors, so we'll keep an eye on it. Silver, put a trend channel in there as well, also fallen out of the bottom of it, but that's not a serious fallout, and I'll keep it there to see if it gets back in the channel again. Similar with copper. This is copper's all-time high up here, and that's the resistance zone up there. It's touched it, it's right up there. I've added a median line in this as well, and let's see how it goes relative to that channel, but is rising and strong and outperforming equities. This is oil, so this is where the weakness is coming for the CRB index. Relatively, oil has been kind of matching stocks now, a bit weaker than stocks, and that looks like a serious breakout through the lower channel line, and let's see what it does. But this is typical of what oil does anyway. So the real key points are these support resistance zones over here, the blue ones that we have. Looking at Bitcoin, there was a short term just on this non-mechanical, more indicative system, if you like, in inverted commas, and it does work pretty well. It does have an edge, is that, and it is, well, let me say, it's mechanical. I'm using mechanically in terms of the crossovers, but it hasn't been researched and doesn't have correct 2 decimal points expectancy and payoff ratios, etc. But it does anecdotally look like it works. There was a one-day trade there, so that is the sell signal shaping up a bit. There's the all-time high, obvious place to find some resistance and a little bit of support when it gets above it. But we have to see. We're looking for a breakout to a new all-time high with conviction and volume, a bit like we saw in the FTSE. Hasn't happened yet in Bitcoin, so that's showing a little bit of weakness. And similar with Ethereum. Ethereum hasn't got anywhere near its all-time high, or not anywhere near. It did a little bit over there, but it's now fallen. Sorry, let's get that back on there. It's fallen below, and there's a support. There's all-time high, got close to it, and fallen slightly out the channel at the moment. There's the risk on, risk off over there. Right, what are we going to look at now? Just to pretty much towards the end, we've got uranium staying in its channel, pretty strong. That's the URA outperforming the uranium. So the URA is the uranium ETF. It's outperforming the uranium price at the moment. There was weakness in iron ore, pretty strong down. Look to see if it would find support at that channel. Sorry, at that trend line. It did, and it's now rising again, heading back up towards 130. Iron ore stocks obviously would like that. Thermal coal, I like what I see over here. It's forming a base at a higher price. Look, I'm not talking about coal philosophically. I'm talking about the price of coal, and you can see where that's forming that price. You can see there are very few bases in, and you find that with commodities. There are some commodities. There are very few bases over here, particularly the ones that the ones that have been around for a long time. You see them all over the place, but these commodity prices that you see in oil, uranium, sorry, not oil, thermal coal, uranium, and some of the others, the tins, the cobalts, all that sort of stuff. Very few have strong bases. And what I'd like to see is a good base at this high price level where buyers and sellers form an equilibrium, and that becomes a good long-term base, and then see what happens from there. And it looks like that is forming. Okay, we're going to go to questions. When did we not have any geopolitical issues? Exactly. There's never been a time when there's never been geopolitical issues and problems, and so that the market takes some of it at its stride, and it reacts to some it reacts to more than others other times. And how do we know which one it's going to react to with what strength? We don't know. And anybody who thinks they do, all they're really doing is they're trying to analyze, they're trying to predict the future and try and work out what's going to happen next, which just leads to trading errors and all kinds of mental stress and fear and all that sort of stuff. So whatever's happening geopolitically, it doesn't mean that what you think that geopolitical event's going to mean for the markets is going to happen. Sometimes it will, sometimes it won't. And which do you know is going to be which? From Don, Gary, is there a reason why you're not using 3-day swing charts or similar to highlight the highs and lows in the price movements, Don? Don, no. The only reason is the cluttering of the charts. But good point. I will from time to time bring it in, but why don't we just do that right now? We'll do this. I'll just clear the chart. I'll go to favorites and I'll bring in swing chart. There we go. That's what Don's referring to. And so there we have the That was a 3-day swing all the way, found a trough, a high lows formed. And when I was saying the high hasn't formed yet, using a 3-day swing chart, is that we're waiting for this to come down and form. So that could go all the way up before it forms. We could have a leg that long going up here again. But I'll use them more, Don, because they definitely do. It's easy to see. So we'll do it. And I don't save them on my analyses just because it clutters things up, but I will definitely do that. That's a good suggestion. Thank you. Right, and Z is saying, very odd to have this rather bullish sentiment with all the ongoing geopolitical issues. Any views on this? Sorry, I thought I did. I saw Jermaine's comment first. Yeah, it's a variable. Geopolitical issue is a variable. It's one of the variables, one of the thousands, if not millions, if you count every participant as a variable, and you should, because in some markets you can get one participant. Most markets you could get one participant make a huge difference. The chief executive of a the largest listed company in the world could make some decision that has these one variable have an effect on what happens in the short term for a stock like Apple or anything else. So it's just another variable. Geopolitical events is just another variable. And how the market reacts to any geopolitical event, or how it did in the past, you assuming that it's going to react in the same way is just false thinking. You don't know, because there's a whole bunch of other variables that have now come into the market or active in the market at this time that weren't active when that variable did or didn't do what happened in a geopolitical sense, that caused the market to react that way. Whereas now all those other new variables that are in or weren't around then, they conspire to react in a different way, and the market does the exact opposite to what it did back then. So, and this is why I say, please do the training intensive training, because all of it is explained in there. If you get what's in there, and it's not, all I've done, Dave and I have done is really brought to the fore the most important parts, the real critical parts of Mark Douglas's book, Trading in the Zone. So we are helping you get Mark Douglas's material, not our material. All we're doing is bringing it to you in a fresh and hopefully different way and a different order, so that you get it. And if you get what's in Trading in the Zone and Mark's material, you won't, with respect, you won't ask questions like that, and nor would we have the discussion in the forum that we're having now, because if everybody got it, they would understand the answers to the questions that they're asking on the forum. So I just implore you, please do the training, and then we can all as a community move to a whole higher level of understanding, and then the questions that we ask can be up here rather than down here. And I would love that. I really would. And everybody here at Sharewell Systems would love that. And I'm sure there'd be hundreds of our members that would love that too, because then we can start tackling questions and discussions of a much, much higher order. So I implore you, please do the training. Right, here, that's it. No more questions. I think you've got the theme for what's happening here. Some early signs of some of the risk-off sentiment and breadth of market indicators starting to turn. And we'll see if, and I'm using the smooth index rate of change, the CIROC indicator, as an overlay on those early signs to see if they all come to the party as well. But at the moment, it's looking like risk on. And of course, our portfolios, if you followed all the signals in both the US and Australian market, should all be fully invested, because those signals have all been coming up. So I'll leave it there. And pleasure, John. I'll be back in 2 weeks' time to see how this adventure plays out of potentially going to new all-time highs and to uncharted territories. In the meantime, I wish you consistent and objective and peaceful active investing.